So there's kind of a trend that's been very interesting, and I've been following. It has made a huge impact on the real estate market here in Las Vegas. Last summer in 2023, a Miami-based firm bought 294 houses in one transaction, and that $98 million deal went down with hardly anyone noticing. And as a result, those types of deals are taking a lot of the entry-level homes or the single-family homes off the market that is usually purchased by not only all of our investors, but also your first-time home buyers. So this type of transaction has a huge impact on the market, but you don't see it anywhere. The majority of the homes sold were in the city of Las Vegas, about 94 of those, followed by the city of North Las Vegas, 77, and the average price was about $371,000. These were your typical 3-bed, 2-bath, 2-car homes that most of our clients purchase. This local sale was just a segment of a much larger deal between Starwood Capital and Invitation Homes, a $650 million swap for a portfolio of a close to 1,900 rentals in the Sunbelt. Those areas included Phoenix, Florida, Texas, and Arizona. So this type of transaction affects our market in two separate ways. One is our investors don't have anything to buy. And the second thing is there's a lot of rentals that are on the market, and that is pushing the prices of rentals down. So the returns on investments for our investors have been flatlining in the last year or so. There's some interesting correlations and parallels that we can draw from this type of transaction. Some of you may remember the type of mortgage debt that happened in the last mortgage meltdown. And in those mortgages, there was a lot of toxic debt. And what that meant was there was a lot of people that were marginally qualified for loans, and some of those loans were not even performing. And I think this could be happening in this type of environment where equity swaps are occurring, all these houses are being sold from one institution to another institution, and no one's really paying attention to the leases and the quality of the tenants that are inside those transactions. And I predict what's going to happen is over time, those leases become more and more toxic. And as transactions occur from one institution to another, what happens is the quality of those tenants and the quality of those leases are going to continue to downgrade. Eventually, some institution ends up with a bag full of crap, and they're going to not be able to pay the notes that they have on that portfolio that they have. And I think what we might actually happen is a sudden collapse where an institution suddenly can't keep up with the debt and puts 500-600 homes on the market all at one time. But in the meantime, there's really nothing to purchase. Not only is there nothing to buy, even if you did buy it, the return on your investment is less than 4%. And frankly, if you can get a CD at 4.5%, you might as well go for the CD. It's a lot less brain damage. You know what you're going to get, and it's secured by the FDIC. Sadly, every week we get a new investor that purchased a property from another brokerage and comes to us to manage their property. And they are sad to discover that the returns that they were expecting are nowhere close to what was advertised. And unfortunately, there's no way out for these guys because they can't put it on the market for less than what they expected and still make a profit. And obviously they can't sell it because if they did, they would lose money. So I kind of really feel sorry for a lot of investors who purchased recently. So in the meantime, hang on to your pennies. The market will be back. There will be opportunities in the future. Just don't know when.